Yeah, we'll keep that one in the back of our minds for maybe an NFP. A little bit of Game of Thrones soundtrack to get us going. Now, look, been an interesting day. I mean, day before the FOMC, usually you do get a bit of profit taking, a bit of pullbacks, but pound was a bit. I mean, if you're a conspiracy theorist, you're like, wow, who did that? I mean, why did they do that? That's a big buy. No news. Someone's liquidating. I mean, you're straight to the fresh high. I mean, a new high from the Monday little rally. Could just be, low liquidity, stop hunting, but you can't do that without nothing, right? That takes something. Let's see if we can hold up here. I mean, half the time when you want to get the market turn around, you need to see price action like this. You need to see some sort of basing, some sort of just grinding higher without news. Yeah. Now the Article 50 is going to be triggered at some point, and the market is quite low, so the ability to have short squeezes, that turn quite nasty is going to be on the cards at any point, right? At any point at all. So if you're a seller, you have to keep that in the back of your mind. Make money while it's good. Be concerned when stuff like this starts to happen. And this is 5 or 6 days in a row that you could have sold the pound quite easily. Basically the S&P stuff dragged it below that previous sort of support, and then it was on for the sellers to take control. But I mean, in terms of timing and news-wise, I mean, there was a poll put out that said the Scots don't want to, if the referendum was taken today, they would vote to stay in the UK. I mean, that's something, but probably you want a more standard reason to trade than that, right? That's the Scots. But also the FMC added to a little bit of jittery. I suppose no one wanted to make big bets there. And what's the risk tonight with FOMC? Well, the big risk is that they raise and the market plays buy the rumor, sell the fact, right? And if you traded for 6 months or more, you know that it does this so regularly, the market, that it's very hard and very dangerous to be buying US dollar today. Yeah, and there's a lot of pairs which are attempting to rally, like the Aussie and the Kiwi and the Euro, since the bottoming out last week pre-NFP. Now that alone is sort of dangerous signaling that the US dollar isn't as strong as it would have been if these numbers, sort of was a bit more of a line ball decision. I mean, we've been told the big rally for this rate hike came that day when 3 or 4 Fed members came out and said, "Oh, we think March is a good day to raise rates," and the yields surged. Now, not to say you can't get a US dollar rally today. I mean, you can get a US dollar rally quite easily too. I mean, if they come out and those Fed dot points suggest that they're raising again in June, or potentially 3 more raises are coming after this rate hike this year, so 4 this year. Just a minority slipping into that sort of view, that would lead the US dollar to have to strengthen, right? You can't ignore that. But that is still to be put out there. And what you might see from Yellen is a bit more of a conservative approach. He normally has a bit of a conservative approach, a bit of a patient, let's wait and see the effect of the rate hikes, and perhaps look at some of these fiscal policies of Trump and the new administration and see how they're going to impact their forecasts. Right, so I mean, there's reasons for them not to be ultra hawkish. But then you have to ask yourself, well, if there is a US dollar sell-off today, just positionally, and she does come out neutral, is that going to provide us an opportunity to buy the US dollar? Right, I think that does. And the main way I'll be looking to buy the US dollar is against the yen. Alright, so dollar yen, I'm hoping for this US dollar weakness to come through, and I'm hoping dollar yen to pull back to around 114, where I can get some nice risk reward, I believe, on the buy down here. And while the euro might want to rally, and the pound might do its own little thing in coming days, and the Aussie might do its own thing in start coming days, dollar yen, euro yen, Aussie yen, pound yen are suspecting for some nice moves higher in the coming weeks. So I don't mind the big one, the dollar yen falling, and I do believe that the yen is going to be at the bottom of the pile. Now, the main risk to this trade, apart from dollar yen not finding support at 114 and keeping to fall and going back into, say, a range trade between 112 and 115, is stock market, right? The stock market is the wild card here. Stock markets can easily fall from these levels on any number of reasons, and that would put a drag on this. Yeah, and if any sort of new political risk comes up, or I don't know, the G20 this weekend, you see the US Treasury Secretary come out with a ultra aggressive anti currency manipulation stance, going after China, or some regard like that. I mean, you can get risk off in this market, quite easily, and in some ways it would be good for the stock market to have a more substantial pullback than it's had, because it's defying gravity a little bit, and that's never a good thing. But it's slowly making its way to the bottom of that trend, so that trend channel, if it goes sideways long enough, it actually will hit that, more buy sort of zone. It could go down here, straight down, but if it rolls across, then it's also doing the same job. Sideways is a form of consolidation. So yeah, I mean, it's an interesting market. It's an interesting market. I do like the euro to be trying higher towards 107, 150 to 108 in the coming days. Netherlands vote today probably is a little bit of a stop sign for the euro rally. But let's see what the market does. If it comes out and there isn't a huge Trump or Brexit-like swing towards the nationalistic party of PVV is the party you should be watching out for, and how they go. That's on today too. There's a whole host of US data out early as well, before the NFB. So it is action stations today. In terms of, I had a little look around to see what caused that pound move. Citibank put a little note out. What did they say? Not any fresh news to explain the move. The world's over. Scottish voters don't want a referendum. Blah blah blah. We talked about that. Could be a possible reason. Yeah, they literally have no idea though. You don't need a move for that. You don't need a reason for that big a move. It's not that big a move, right? So yeah, the state of play in a few of the trades that I've been looking at is definitely interesting. I've got stops here on the euro yen, just in case I'm wrong. Has happened before. Euro pound short. And so yeah, I mean, it's I won't be sticking around too much longer if it rolls over. A little bit low. Don't want to get wiped out in some sort of Yellen manic response. Dollar yen going sharply lower without the euro having time to respond. If it gets there though, that's the 121. I think we're going to get much movement in the stocks, potentially. If it comes out hawkish, that could lead to market selling. Dow, if you want to know why the DAX is struggling, when the euro goes up, the DAX rally will stall. So you start to see a nice little euro rally in the coming days. The DAX is going to struggle. Yeah. That relationship's still in play. But yeah, I don't suspect, unless it's a major surprise, that the Dow will do anything dramatic. If it comes off a little bit dovish, wait and see approach, then Dow will probably rally. And that will counter trend. That's another reason I like to buy dollar yen on dip, because that counteracts some of the dollar selling in general. Yen will be sold in that risk on environment, not against the US quickly anyway, but against say Aussie yen and Euro yen. They'll buy that up if stocks were to surge. Now, let's go into a little bit more depth about the FOMC. I've got a little cheat sheet here from ING. FX Ram always has a good comments. He's a man to pay attention to in the chat room. That's correct. We do have the US CPI, and that's growing in importance. We started to see heat come through last month. Strong moves higher. Now it's forecast to revert to the mean here and have a bit of a smaller growth. If you can see month on month after that stellar month last month, we're talking at 0.6. Remember, that came out. I was like, whoa, everyone was like, what is going on? And yeah, that will be in play in 6 minutes. We'll watch the pound reaction to the earnings. Remember, the claimant count's not the big one. The big one is the average earnings, which is what the Bank of England wants to see. A lot of central banks want to see this stuff too. Their wage growth start to pick up. Yeah, you don't trade stocks on FOMC day too much usually. Not unless they're cutting rates and you're buying DAX, right? In the ECB back in those days. Alright. Let's have a look. Little cheat sheet. Alright, so their base case is a 25 base point rate hike. I mean, that's everyone's base case, I think. They suggest that the median dot points are not going to be moved up too much. Just a little bit. I mean, if this is not moved, that's a sell. Raising rates, dot points don't move up, or less than this, then that's a sell. And the main reason, economic driven, is fiscal uncertainty. Blah, 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 blah. Don't know what Trump's doing. Obviously, if they talk about concerns about inflation, and if inflation comes in strong today, they might be. Recent inflation's picking up, blah, blah, blah. That will lead to, potentially a change in this little line. Gradual increases in policy. If they say anything like could tighten faster than anticipated, oh, Jesus, it's on. Alright, the base case is fiscal uncertainty. We don't know what Trump's going to do. And in terms of the QE balance sheet, they've got trillions, remember, on their balance sheet. Dovish is if they come out with shrinking won't be considered to 2018. That's, yeah. No decision discussed, but more work needed. Okay, that's probably what's going to come, right? And fiscal policy assumptions, they don't know. If they come out with that, so yeah, the chances of 3 rate hikes by the market's been priced in a fair bit more. There's still some little bit of movement for the for that to be fully priced in. Now, ING don't think that's going to happen. They think there's a few reasons why there won't be 3 rate hikes this year. So maybe, you know, raising rates today, but then only one more in the rest of the year. Alright, so we've got here. There are a few reasons for not penciling a June hike in our forecast. The US economy often has a mid-year lull. Trump's fiscal plans may be watered down by Congress' congressional budget. That's also coming out in the next couple of days. Or his budget. Wage growth may stall. And political upheaval could come across into uncertainty in the markets, stock market selling, yada yada yada. Tapering reinvestments of the proceeds of treasury holding could act as a de facto hike later in the year. That's true. So they're not talking about tapering, they're talking about actually getting out of their positions. That is effectively selling bonds, right? Which, if you sell bonds, you increase the yields. So remove a key buyer of the treasuries market, blah blah blah, reducing the need for rate hikes at the short end. So yeah, interesting stuff. Interesting stuff. Alright, so, and yeah, this is an interesting point. They think that the market's overestimating how quickly the Fed's going to raise this year, but underestimating how much they're going to do by the end of 2019. Yeah, let's have a look at this pound and see what comes out. Ooh, weak earnings. It's going to be of concern. Computer is not updating for me. Very strong claimant count change though. And a drop in the unemployment rate. Ooh, mixed bag. I think the weak earnings is probably more important. I don't want to see that. I would rather have had weak earnings, strong earnings, and weaker numbers than the other two, right? This is not what you want to see. That graph is going the opposite way now of what you want to see in the last few months. Yeah, a few of my clients, they do trade gold. One of the interesting reports I read earlier today, I'll share with you as well. Just quickly before we go back to a little bit of... I mean, with all these uncertainties about Trump and European politics and stock markets not having pullbacks and stuff, you could see definitely situations this year where gold is going to do well. Yeah, now... Gold's definitely going to go high if stock markets pull back. They're suggesting because of the volatility of gold so small these days to use options to do it. Now the GDP numbers, tracking numbers out of the US have started to fall. that could lead to a re-evaluation of the earnings potentials in stocks. Falling quite sharply too, like 3% down to 1% for the first quarter. And they make a little note, this is UBS here. If US Q1 GDP ends up around our current forecast, this would represent one of the weakest quarters that the Fed would have hiked rates over the past 30 years. Fed rate hikes during relatively softer periods have typically coincided with equity market instability. Alright, so they're suggesting maybe use gold as a hedge. I mean, it's not the worst thing to be buying gold. I mean, how much downside do you got? 10, 20%? I mean, it's not the easiest thing to trade, day trade though. But it is something to keep an eye on, this US GDP being weak. It's Deutsche Bank, what to expect from the FOMC. Oh, Potter, please don't link that in the chat room, man. Gonna get us all in troubles. Okay, in one of the most effective episodes of Fed communication in recent memory, members of the FOMC turned market expectations around and removed them, all essentially doubt of a rate hike this week. The main question that remains is just how hawkish the message that accompanies the policy move will be. Will the committee strive to boost market expectations of additional rate hikes in the near term? Deutsche Bank's Peter Hooper thinks the quick is no, most likely not. Inflation is still well behaved, running a little below target, so inflation numbers are important tonight. And there's still more than enough fiscal uncertainty, so Trump's plans, that it's hard for the Fed to project too much. That's a good way of looking at it. Alright, we've got a delayed reaction here in the pound. It is started to fall, finally. See, RS is here, Potter. Alright guys, so yeah, I mean, look, keep an eye on this US data tonight. That will have a small impact on probably expectations going into that FOMC. Expect there's many scenarios where you will get that US dollar weakness. Keep an eye on dollar yen as she speaks, as the statement comes out. That will give you the clearest indication of what's going on. Keep an eye on the US yields, 10-year yields. If they break the 10.64, then it's fairly safe to say that dollar yen will be higher. Now 2.58 at the moment. We'll see how it plays out. I suspect that there will be non-committal on the rate of next rate hikes, and so we will have reason to get that US dollar pullback. That pullback I'm looking to buy with dollar yen, is especially if stocks look well supported on it. That's to me dollar yen and euro yen. And if I was trying to look for a third trade, it would be straight euro buy, or straight Kiwi buy. Kiwi I haven't looked at yet. Kiwi dollars stalled to the downside at the key support. Once it stalls, Kiwi dollar regularly goes higher. So if we can survive this, this FOMC today, then I'll be buying, and hopefully we can get past 70 and just see how it goes. I mean, literally, if the market settles down or calm comes back in, then they'll probably just come back to the Kiwi here over time. So that's the other trade of playing US dollar weakness if you like it. And obviously Kiwi yen and euro yen makes sense too. Alright, trade safe, guys, and I'll be back tomorrow to 9 GMT to review the carnage.